Hey guys, in this video we go through our August update of our $124,000 Tfsa dividend growth portfolio. We'll look at our 20 holdings and which stocks we bought. Let's do this! As most of you know, my wife and I do our finances together. We have 3 accounts through 2 brokerages for our Tfsa, Scotia iTrade and Wealthsimple. The month of August was interesting. Earnings season continued, and after recording a post-bear market high on July 31st, the S&P Composite 1500 slid 5%, accompanied by all sizes, styles, and sectors, as well as nearly 90% of its 153 sub-industries. The deepest declines were endured by the mid and small cap indices, along with the materials, tech, and utilities groups. Conversely, the energy, healthcare, and industrial sectors fell the least. Our portfolio was down slightly on the month, and though it continues to underperform the NASDAQ, S&P 500, and Dow Jones on the year, it finally had a month of outperformance, as you can see here. So should September live up to its down reputation, where might investors like you and I find pockets of potential outperformance and underperformance? 6 sectors outpaced it, led by consumer discretionary, consumer staples, and energy, while underperformance was most evident in materials, real estate, and utilities groups, as I've been saying for quite some time. But history is history, and who knows what this September will actually bring. All I do know for sure is we will be away most of September, enjoying the sun and sea far, far away. Before we begin with this update, we want to tell you more about the soft launch of moomoo Canada. It's like Yahoo Finance meets brokerage, but on steroids. One feature I find very useful is the comprehensive stock screener, as you can see here. And it's also great for paper trading for those that are new to investing or experienced alike. And it's a nice place to do quick research with all the information you need at your fingertips. So if you're like me and like free, sign up to moomoo with my link below and have the chance at winning some amazing giveaways like a $100 Amazon gift card. First, we have VFE, Vanguard's non-hedged S&P 500 index ETF. VFE still makes up 0.2% of our portfolio. It was up 1% on the month in spite of the index actually losing on the month. Thank you, Canadian dollar, for falling. Our allocation target of 5% remains the goal. The index is trading at an elevated PE level of 25.74. Historically, with a PE above 25, returns have been relatively low or even negative. Next is GoEasy Ltd at 0.4% of our portfolio. It finished the month flat. At one point, it was up 51% from its low in May. With its market cap again above $2 billion, this is a mid-cap again. GoEasy is in the credit services industry. It reported Q2 earnings at the beginning of the month. They were good in my opinion. Despite the new regulations on maximum interest rates, GoEasy was able to have record demand. Its revenue was up 24% and adjusted EPS up 16% from 2022. Record number of new customers at nearly 42,000. And 53 consecutive quarters of same-store revenue growth. Good job, GoEasy. Next is Canadian National Railway. It makes up 1.1% of our portfolio. It finished the month down 5% and is down 10% since April. Q2 earnings were released. The CNR changed its economic outlook at earnings and is now expecting recovery to be pushed to 2024. Short-term pain is seen in its stock price. And if you have been following its key weekly metric updates on its investors page, of their website of course, you would have noticed the continual downtrend. We added 2 shares at a price of $153.49. That added $6.32 to our forward annual dividend income at a yield of 2.1%. Next up is Brookfield Corporation. It represents 2% of our portfolio, up from 1.7% last month. It finished the month flat. BN reported Q2 earnings and they were good considering the circumstances. Distributable earnings were flat compared to 2022, but are still up on the 12-month compo. The noticeable decline was seen in BPG. Its earnings were down 16%. This is definitely a major drag on Brookfield Corp right now. They were able to deploy $50 billion year to date though. We added 7 shares at a cost of $44.39 a share. This added $2.65 to our annual dividend income at a yield of 0.9%. Next, CANOE EIT Income Fund makes up 2.4% of our portfolio. It was flat on the month. Its 5-year performance is looking good at 14.2%. It has changed its portfolio makeup quite a bit though. It's now 20% financial, 19% energy, 17% industrials, and 15% healthcare, with nearly 60-40 split between Canada and US equities. Then we have FIERA Capital. It represents 2.6% of our portfolio. FIERA finished the month down another 8% and is down 31% on the year, not including its dividend though. We maintain this position on the chopping block with its fundamentals worsening and our investing thesis no longer holding. FIERA reported Q2 earnings. We were hoping for a stabilization of the AUM, and that happened this quarter. However, LTM free cash flow continues to drop. The dividend was approved again, thankfully. Next up, Algonquin Power and Utilities Corp makes up a sad 3.2% of our portfolio. Algonquin was down 5% on the month. They reported Q2 earnings. What did we learn? Algonquin is going to pursue the sale of the renewable energy group. The CEO is no longer with them and are searching for his replacement. And what is the worst of all? Though revenue was up, adjusted net earnings were down 49%, and interest expense increased by another $25.1 million year over year. We will wait one more earnings report to see if we will scale out of our position. Next, we have TD Bank at 3.6% of our portfolio. It finished the month down 5%. It reported Q2 earnings at the end of the month, and they were no bueno. The earnings season for banks has been bad so far. Here are a few lowlights. Reported earnings were down 8% compared with the third quarter last year, and adjusted earnings were down 2%. US retail reported net income decrease of 12% in US dollars compared with the third quarter last year, and PCLs were $953 million, an increase of $691 million compared with the same period last year. TD's Common Equity Tier 1 capital ratio was still healthy at 15.2%. I highly suggest a full read-through though. Do you guys like these kind of portfolio updates we do? If so, please consider 2 free things. Subscribe to our channel and hit that like button to spread this video to as many as possible. A shameless request, I know. Next, we have MANULIFE Financial Corporation at 4.4% of our portfolio. It finished the month down 5%, and it too reported Q2 earnings. We should be calling this the earnings update, not portfolio update. Anyways, the earnings were decent. Core EPS growth of 6%. They have repurchased 1.8% of their common shares so far this year, and their adjusted book value per share is now $29.42. We bought 1 share for $24.26. That added $1.46 to our annual dividend income at a yield of 6%. Next up, we have BCE Inc. at 5.1% of our portfolio. It is flat on the month and is still down 13% since its high in May. Q2 results are out, and the higher cost of borrowing is starting to weigh on them. Revenue growth, 3.5%, and EBITDA, 2.1%. However, adjusted EPS was down 9.2%, and FCF was down a substantial 23.8%. BCE confirmed its financial guidance targets for 2023. I still view BCE as a bond-like holding in our portfolio. So we added 1 share in the middle of the month at $54.81. That added $3.87 to our annual dividend income at a yield of 7.1%. Next is FORTIS, representing 5.5% of our portfolio, down from 5.9% last month. Utilities are also getting hammered in this high interest rate environment. It finished the month down another 6%. It released Q2 earnings, and here's my take. Adjusted net earnings per common share was up 8%, and their $4.3 billion annual capital plan is on track with already $2 billion used. Fortis expects its long-term growth in rate base will drive earnings that support dividend growth guidance of 4 to 6% annually through 2027. I'll be looking to add upon further weakness. Next, we have PEMBINA Pipeline Corp. It represents 5.8% of our portfolio. It traded flat on the month again. PEMBINA reported Q2, and here are some highlights. They repurchased a small amount of shares, 50 million worth. PEMBINA paid down $450 million in consolidated debt using proceeds from the sale of PGI's interest in the Key Access Pipeline system. Revenue, gross profit, EBITDA, EPS, cash flow were all down substantially. The good thing is EBITDA guidance for 2023 has been narrowed and not lowered. Next up, we have TELUS Corporation at 6.4% of our portfolio. TELUS remains stuck in this downward channel since April of 2022, and it's looking quite oversold, yet the selling just does not stop. It is up 1% on the month, yet still down 33% from that April 2022 high. Q2 earnings came in. They are targeting consolidated operating revenue and adjusted EBITDA growth for 2023 of 9.5 to 11.5% and 7 to 8% after what was announced last month regarding TELUS International. Also, TELUS updated its free cash flow guidance for 2023 to approximately $1.5 billion to reflect significantly higher restructuring costs. Part of that restructuring was a reduction of 4,000 workers at its main TELUS business and another 2,000 at TELUS International. I expect some corporate bonds to be issued soon. In any case, we continued the buying spree and bought 17.466 shares at an average cost of $23.07. This added $25.40 to our forward annual dividend income at a yield of 6.3%. Our next biggest position, ENBRIDGE, represents 6.7% of our portfolio. It finished the month down 2% and is now down 11% year to date, not including its dividends as always. Just like with PEMBINA and other energy stocks, ENBRIDGE is super high yielding right now and rising. It is important to note its payout ratio is still healthy. Q2 earnings were released at the beginning of the month and were solid. EBITDA was up almost 10% quarter over quarter, and financing costs have been stabilizing. 2023 guidance was maintained, and the midterm outlook shows a 4 to 6% CAGR on EBITDA and EPS. We bought 7 shares at a cost of $47.85. That added $24.85 to our forward annual dividend income at a yield of 7.4%. Next, we have our 5th largest holding, Tfsa Energy Corp, at 7.2% of our portfolio. It traded up 4.5% on the month and is still down 8% on the year. Q2 earnings were released at the end of July, and I shared my commentary on it last update and also made my first short courtesy of my wonderful Mrs. Financial about those results. We added 4 more shares this month at a cost of $46.85 per share. This added $14.88 to our forward annual dividend income at a yield of an amazing 7.9%. Next is SMARTCENTRES Real Estate Investment Trust at 7.3% of our portfolio. It lost 3.8% this month and is now down 10% year to date. Real estate continues to suffer. Q2 earnings didn't reveal anything new though. In place and committed occupancy rate of 98%. The trust fixed rate versus variable rate debt ratio was 83% versus 17% as of June 30th, 2023. Same property NOI increased by 3.2% as compared to the same period in 2022. Weighted average interest rate percent was 4.03% compared to 3.3% last year. Payout ratio to AFFO was 93.4%. So all in all, we continue building our position at these levels. We bought 4.474 shares at a cost of $24.80. That added $8.28 to our forward annual dividend income at a yield of 7.5%. Our 4th largest holding is First National Financial. It represents 7.9% of our portfolio. It finished the month down 3% and is up 1.5% on the year. They released their Q2 earnings. Here are some of the highlights. MUA grew to $137.8 billion from $127.3 billion last year, an increase of 8%. Revenue for the second quarter of 2023 increased by 26%. This change was largely a result of higher interest rates. We all know that. Payout ratio was 41% on the quarter and 58% for the year so far. We are still waiting to add to this position though. Our 3rd largest holding is Capital Power Corp. It represents 8.2% of our portfolio. CPX finished the month down 1% and is down 12% year to date. Q2 earnings were released at the beginning of the month and they were in line with expectations. Results were impacted by untimely outages though. Increased annual common share dividend by 6% to $2.46 per year, representing the 10th consecutive annual increase. Gotta love that. And they reinstated the company's dividend reinvestment plan, or DRIP, effective for the 3rd quarter 2023 with a discount of 1%. So we bought 8 more shares at a price of $39.82. This added $19.68 to our forward yearly dividend income at a yield of 6.2%. Our second largest holding is Bank of Nova Scotia. It represents 8.4%, down from 8.8% last month. It finished the month flat and is flat on the year. Financials have been under pressure all year, and the pressure continues to mount here in Canada, especially with the housing debt situation. At the end of the month, Q2 was reported along with other banks. They have been bad so far. Expectations were so low that the results met those low expectations, and it didn't impact prices as much as one might think. Here are a few things to note. Adjusted EPS was down 18%, and adjusted net income was down by 15%. The total allowance for credit losses was $6.1 billion. The next few quarters will be painful if inflation continues and interest rates remain high or even increase. We added one share at a cost of $65.27. That added $4.24 to our annual dividend income at a yield of 6.5%. And our big boy stays the same in the portfolio, RIOCAN Real Estate Investment Trust. It represents 11.7% of our portfolio. RIOCAN is down 4% on the month, and year to date it is down 8%. As I've mentioned for many months now, real estate continues to feel the heat and has provided attractive valuations for REITs in Canada and the US. Q2 was released, and here are some standout numbers in my opinion. 44 cents funds from operations per unit. 59.7% payout ratio by FFO, 97.4% committed occupancy. Ratio of unsecured versus secured debt was 57%, 43%, which is drastically higher than SmartCentres. Hopefully this gets to the 70% as desired by year's end. 44 million square feet of development in the pipeline, and 10 to 12% total unit holder return calculated over a 5-year period. We were able to drip 3 shares at a price of $19.48 at the beginning of the month. This added $3.24 to our forward annual income at a yield of 5.5%. So there you have it, all 20 holdings we own and which stocks we bought in August. We deployed $2,175.23, adding $114.86 to our forward annual dividend income at a yield of 5.3%. We still have a lot of work to do in this portfolio, with about $47,000 in TFSA contribution room to go. Thank you so much for watching, investing friends, and helping the channel out by smashing that like and subscribe button. You guys are the best. Until next time, I'm Mr. Financial.